Good morning, good afternoon to everybody, depending on where you're at. My name's Duane Lund, and I'm going to be your host for this call. Just a few housekeeping items. We're going to do this. I'm just going to do this without a PowerPoint. So I'm going to give you about a 10-minute snapshot on who I am, what I do, and how bonus depreciation fits into our real estate portfolio, and how maybe you can hopefully use some of the same tools we use. And then at the back end, we'll do a Q&A, and Rishav is kind of running this for me, and I believe you can either type in a question or you can ask a question. And then just so everybody knows, after this call, and again, the goal here is 10-15 minutes, kind of keep it short. Just know that I'm available, and Mark Creason, who's kind of one of my co-hosts on this call, we're both available to take calls. We have PowerPoints, we have flyers, we have PPMs. So just so everybody knows, part of it is just to give you an introduction to what we do and how we do it. And then we can follow up with specific information about different deals in our portfolio and maybe how we can help you. So those are just the housekeeping items. So let's get started. My name is Duane Lund. I'm the CEO of NAI Legacy. I'm assuming most of you recognize the NAI brand. It's on the shirt if you can see it. But NAI, as most of you know, we're one of the largest brokerage firms in the United States. We have about 6,000 real estate brokers, 300 offices. We've been around for over 40 years. And I joined NAI about 5 years ago. Prior to that, way back in the 80s, I'll age myself, I was a CPA with Pete Marwick back in the mid 80s. And then I jumped into commercial real estate in the late 80s. I was in the real estate investment trust arena for almost 15 years. I was actually the CEO of a public REIT for a while. And I've been a private real estate investor my entire career, which is going on close to 40 years. But here's one thing I'll say, and it kind of leads into today's presentation. That entire 40-year run for me, for the most part, and this ties all the way back to my CPA days, I've kind of been, well, I'll just call it kind of a tax nerd, kind of a creature of the Internal Revenue Code. And throughout my entire career, I've always looked at the tax attributes of real estate and really take advantage of the tax attributes of real estate, both for my clients, my partners, and for myself. And whether we deduct it, we contribute it, we transfer it, we defer it, all different techniques we use at our company. The code has been pretty favorable to real estate. And today's presentation, we're going to talk about deducting it and specifically depreciation. But just so you know, if you want to talk about contributing it or transferring it, which is more of an estate tool, or deferring it, which is 1031s, I'm available for other webinars and other calls with all of you. So let's talk about deducting it, and specifically depreciation, and just some of the current legislation that's in place and some of the proposed legislation that's in place. But depreciation in its simplest form, we buy these buildings, and you buy these buildings. I'm assuming many of you own real estate. And I'll just tell you the 101 of depreciation, and I still see it even to this day. Most people acquire real estate, and then when they put their basis on their tax return, most people go, on average, 20% land, 80% real property. And they depreciate that 80% using the real property rules, which, as you know, is 39 years for commercial, 27 and a half for multifamily residential. Well, in 2002, for the first time under the code, we heard the word bonus depreciation. And in 2002, the rules were really specific to mostly personal property and to some real estate assets, but not many real estate assets. And the game changer was in December of 2017, the Tax Cut and Jobs Act. And the Tax Cut and Jobs Act that went through in December of 2017 created bonus depreciation for real estate owners. And for the first time, we could take advantage of bonus depreciation for properties that we acquire, as opposed to just properties that we build. And in its simplest form, the way the rules worked, remember that 20/80 that I mentioned, for the first time, you could take that 80% allocation and you can bifurcate it. okay? And let's just use a really simple number. Let's just say it was a $100 property. You put $20 into land and $80 into real property. Under the rules that came through in 2017, what we now do with that $80, that 80%, is we bifurcate it. And we bifurcate it typically with a cost segregation study. And you can also, use your own set of rules, but we usually like doing cost segregation studies. Most major CPA firms have cost segregation divisions. There's also third-party engineers that do these cost segregation studies. But what we do typically is take that $80 and we then put it into 5, 7, 15, and the real property category, the 27 and a half years or 39. But the key is to identify personal property in that 80% number. And for most real estate assets, stuff like, and most people forget about this, stuff like landscaping is 15-year property. Your parking lot is 15-year property. Inside your building, the HVAC, the mechanical system, some of the steel beams, loading docks, all of that property that's attached to your building falls into the personal property categories of 5, 7, and 15-year life. And when you allocate it to those categories under the Tax Cut and Jobs Act, we then can apply bonus depreciation rules, and we write off 100% of the non-real property in all of our buildings. Okay, so going all the way back to the 2080, I'll just tell you that 20% land on average, and of that 80%, it's not uncommon for almost half of that 80% to fall into the personal property category. Okay, and then the balance goes into that 27 and a half or 39-year life. But bonus depreciation, it's a really effective tool. Our company has been involved in syndicating, probably for lack of a better term, syndicating Code Section 168. Code Section 168 is bonus depreciation. And what we do is we take properties, we do these cost segregation studies, and then we slice the property up, for lack of a better term. We slice them up using what's called a Delaware statutory trust, and we sell to investors depreciation losses from our buildings. Okay, and what we do is we attach a cost segregation study to it, and for a real estate professional, and I'm assuming based upon the profile of some of the people that signed up for this call, most of us fall into the category of a real estate professional under the code. The beauty of this depreciation is not only does it offset the income from that building that you bought or the building that you buy from our group, but you can use that loss to offset income from other real estate assets. And if you're a real estate professional under the code, you can also use it to offset income from other sources. That's the beauty of it. That's the beauty of it. And the way this whole thing works today, so the Tax Cut Jobs Act put 100% bonus depreciation in place, and 2023 was the first year that, as opposed to 100%, it got lowered to 80%. In 2024, it's 60%. So in its simplest form, when you get that depreciation loss in 2024, you can use 60% of that loss in 2024, and the 40% that you don't use, you carry that forward to 2025. But here's what's happened. On January 19th, there was a bill that was passed in the House. And that bill, which is called the American Family and Workers Act, that passed the House, and it's a bipartisan bill. It has several provisions, but it also had a provision on this bonus depreciation rule. And the way the bill passed the House, it reset bonus depreciation back to 100%. And it's retroactive to January 1st of 2023, and then it's 100% in 2024 and in 2025. And it passed the House. We have not yet heard when the Senate is going to take it up for vote. But given how that bill passed the House, the optimism right now in the real estate professional community and the CPA community is that this will pass the Senate eventually. And if that passes, these cost segregation studies and this bonus depreciation, we're back to 100%. which is what we've been enjoying in 2018, 19, 20, and 21. So we'll see what happens. But this depreciation tool, and I'm not going to take a deep dive in this forum, you know, for those that have large portfolios, active versus passive, business loss limitations, interest income deductions. There's different provisions that we all have to look at depending upon the size of your portfolio. I don't want to do that deep dive on this forum, but just, you know, those are all different things that we can at least look at for you and your portfolio and apply. So how does this work? Let me give you a couple of real life examples. So I will tell you that in our multifamily assets, on average, these cost segregation studies have identified between 25 and 35% of our basis as personal property. Our industrial deals, on average, we've been coming in around 20%. Okay, so 20% land, 20% personal property, 60% real property. Mini storage, self-storage, if you're active in that space, you can expect up to 50% of your basis qualifying as bonus depreciation. Retail, I own a lot of net lease properties. Our net leased assets, these are like Walgreens, Sherwin-Williams, CVS's. Those properties have been coming in between 20 and 30%. And again, the biggie for a lot of the net lease properties, it's the parking lot and the landscaping, okay? And all the exterior improvements to the site, all of that falls into the 15-year category. And then the asset class that is really our favorite asset class for taking advantage of bonus depreciation is convenience stores. And specifically, convenience stores where there's fuel sales, gas sales, and there's a provision of the code if your property or the tenant of the property, and we own 7-Elevens and Mavericks and Come and Goes and Holidays, those are all stores that we own in our portfolio. If your tenant gross sales are at least 50% from fuel sales, 100% of the non-land basis qualifies for bonus depreciation. Okay, so it's the most lucrative of the asset classes. So for example, a deal that I'm actually working on with Mark Creason right now, we have a Maverick store that we just bought in Colorado. We bought it in November. It just opened in November. This is a brand new store, and the price point's about $10 million. So we acquired the site for $10 million. Maverick signed a 20-year lease, and it's a triple net lease, so there's really no landlord responsibilities. But on that particular store, almost $8 million of our basis qualifies for bonus depreciation. Okay, and on that particular deal, and this is a deal that I'm happy to send to any and all of you if you want to see the deal, because we still have a little bit of room left in the deal. We've sold out most of the equity, but because we have leverage on the deal, 50% leverage, if you put in $1 into that deal of equity, you actually get $2 of basis, right? Because you get your allocation of our debt, and $1 invested on that deal, because we wrote off 80% of it, it produces $1.60 of depreciation. Okay, so you can kind of do the math, and we got a spreadsheet that we share with all our clients, and our average investor in that deal has put in about 300 grand. But you know, if a client put in 100 grand into that deal, because we have it set up as a DST, a Delaware Statutory Trust, so you don't have to buy the whole thing from us. You can just buy a slice. You can, on a $100,000 investment, we can give you $160,000 of depreciation. Now, again, today, 2024, the way the law reads, you can use 60% of that 160,000. But if this legislation passes the Senate, you actually will have $160,000 of depreciation that you can use on a $100,000 investment. So we call it a 1.6x, and that's the beauty of convenience stores. So that's like a real life example of how we do it. And again, a lot of my clients are 1031 investors, and a lot of them have basis carry forward from their previous asset. So they're not looking to take advantage of bonus depreciation, because all they're trying to do is defer their taxes. But to the extent you have a 1031 deal, and maybe you have some additional boot, some excess cash, Or maybe you have a failed 1031. Think about that. Maybe you had a $200,000, let's use a number, a $200,000 gain, and you failed your 1031 because maybe one of the properties you identified didn't come together. Think about this. You could actually take that $200,000 of cash, put it in one of our convenience stores, and I can turn around and give you, you know, $320,000 of losses, and you can turn around and use that loss to offset your 1031 gain that you failed to do. So believe it or not, and Mark Creason and I have worked with clients that have called us on day 46 because their 1031 failed, and we've used this bonus depreciation technique to actually shelter their gain. So here's the summary. And again, we got some PowerPoints that go deeper into some of these examples. The summary in its simplest form is, depreciation, which has been around since I was a CPA way back in the mid 80s. It's always been around, but some of these new provisions that came through in 2017 and how we as real estate professionals can take advantage of it, it remains probably one of the last great asset classes under the Internal Revenue Code that we can all take advantage of. And that's what our company does. We make this product available to investors. Obviously, you can go out and buy properties on your own and take advantage of it. We're happy to help you with anything that you need on acquiring assets or managing them. But also know that our company, has this product where you can buy a slice of a building and take advantage of it. So if you only need $50,000 of depreciation, as long as you're accredited, you can come into our deal. If you need a half $500,000 of depreciation, you can come in and again buy a slice of one of our deals. And again, I'm happy to send that PPM out. It's a deal that we have registered right now and with the SEC, and you can buy depreciation. So that's kind of my synopsis. This is what I've been doing for 40 years. Obviously, I'm also a private investor. I own real estate assets. Most of my partners and clients, and we have about 200 clients in our program, most of them are tax deferred motivated. Most of them are 1031 investors, but more and more, we're finding clients and individuals calling NAI and saying, hey, Duane, what can I do to shelter my 1099 income? Or what can I do to shelter, a gain on a property where I didn't get the 1031 done? So call us. We're happy to be your tax partner. We're happy to be your partner on a real estate deal. And like I said, we'll follow up after this call and answer any questions you may have and or send out information. Mark Creason and I are available. And so I think with that, I'll stop rambling. And I'm happy if this forum allows for it. I think it does, Rashab. If anyone wants to ask a question, I think you could either type it in or ask it. I'm happy to answer any questions if anybody has any.
Yeah, Duane, if you can see the chat window, there are a couple of questions in there.
Okay, I think I can. Okay, hang on. Show chat previews. Let me see if I can get this. Okay, here we go. Let's see. Depreciation saves taxes this year, but is paid when the property sells. So when is it paid? Depreciating, but is paid. Okay, so I think the question is, if I take advantage of depreciation this year, and now I sell my property next year, yes, your basis has been lowered if you take advantage of depreciation. So if you sell your property, yeah, this is not a permanent deferral, right? This is a deduction for the year in which you take it. I will actually tell you, most of my clients that take advantage of depreciation, they end up doing a 1031 when they sell that property. And I think that was the question, is when do you ultimately pay? Yeah, so you take advantage of depreciation in the current year. When you sell, you do have to pay on that capital gains. Another question, real estate professionals with 1031, can we use bonus depreciation in conjunction with 1031s to offset ordinary income from other sources, capital gains? Okay, so I think that was Scott, it looks like, asked that question. So Scott, here's the thing, under the code, I mean, my guess is most of everybody on this call deems themselves to be a real estate professional because we're active in the industry. Just so you know, the IRS looks at it a little bit differently. Okay, so not everybody is a real estate professional under the code. To be a real estate professional under the code, it has to first and foremost be your primary profession. And you have to demonstrate that you've invested over 750 hours a year in the profession. So for example, an attorney that practices real estate law isn't necessarily a real estate professional. But to answer your question, if you're a real estate professional, and again, there are some limitations called the business loss limitations, but for the most part, you can offset other sources of income, including non-real estate income. Okay, capital gains from stock sales, W-2 income. And here's the other thing, and I see a lot of clients that do it. It only takes one of two spouses to be a real estate professional. Okay, so if you're married and your spouse is a real estate professional, I've watched, and again, I don't sign tax returns anymore. I'm actually no longer practicing as a CPA, but I will tell you that if one of the two spouses is a real estate professional, they can typically shelter their spouse's income from other sources. So that's the beauty of it, is you can use it to offset non-real estate income if you're a real estate professional under the code. Another question, with 1031 only able to defer like-kind property, if we cost seg personal property, can that be part of an exchange? Okay, this is a good question. We get this question all the time. Hey, Duane, how is it that I can do a 1031 into a convenience store when the convenience store is loaded with personal property? Okay, and here's the answer, is the definition of real property under the 1031 code is completely different and independent from the definition of real property under code section 168. Okay, and again, you should talk to your CPA, but here's what I'll tell you is you can 1031 100% into a convenience store, even though for depreciation purposes, most of that store is personal property. Okay, so the real property rules under 1031, I don't want to say they ignore personal property, but they definitely ignore personal property under code section 168. Okay, those are two different tests. And I will tell you, most CPAs will opine that at the end of the day, you 1031 into a real estate deal, the way you depreciate it is completely separate. So that's the good news with our program. Personal property 1031s were taken away from us in 2017. And personal property 1031s, that's when people used to trade artwork, used to trade airplanes, used to trade rental cars as an example. So straight up personal property 1031s no longer exist. But don't confuse how personal property works under the depreciation rules versus 1031. Those are two separate tests. Okay, and at least as of right now, those are the only, is it C or B? I see something C or B from Kevin, and I'm not sure what that question is.
He's asking if it's a 506B or a 506C. I mentioned
okay. Okay, yeah. So, and this is, and Mark Creason is one of our broker dealer reps. The offering that I mentioned is a C, and it's a C, meaning that's the reason I can talk about it on this call. But it's a C, not a B.
Hey, Duane, I did some brief calculations on the Fort Collins deal you were mentioning, the 506C, and I calculate that you have about for a $100,000 investment that you have bonus depreciation of just over $100,000 on that particular deal because it's 52.35% loan to value. I come up with $100,734 of bonus depreciation on a $100,000 investment under today's current law. I just think that's a pretty good deal for a 60% on 80% kind of write-off. But just wanted to point that out.
Yeah, and to Mark's point, and if you want to see the specific numbers for any of your personal situations, we have a spreadsheet. We can drop in exactly how much cash you're looking to invest, or maybe better yet, how much depreciation you need. We can back into the number. Just send Mark or me an email after this call, and we'll run the number. Another question came up, and I will hit it real quick. Scott was asking about 721 conversions and how that affects a DST. Now, remember when I started this call, you know, the big four are deduct it, defer it, contribute it, transfer it, right? Those are the four kind of real estate tax techniques we're involved in. The contribution one, when I say contribute it, that's code section 721. When you do a 721, it depends, Scott, on what type of 721 you're talking about. Most people associate 721s with REITs, UPREITs, umbrella partnerships. And again, I'm very familiar because I'm an UPREIT partner in a couple of REITs, but that's a contribution into a partnership. And typically, once you make that contribution into an UPREIT, most REITs, then you're in that UPREIT candidly until either you sell your shares, which are taxable, or, you know, you pass away and you get basis step up under 1014. I will tell you this, if you do a 721, we do DST 721s at our shop, one of the few companies that do it, where we actually have people that contribute property into a DST versus an UPREIT, and then they stay in the DST, and we bifurcate their basis into their different heirs or different partners. So there's some creative ways to use 721 to your advantage if you have a low tax basis. And Scott, going deeper on this call with that, probably not the best use of the time given the forum, but reach out to me. I'm happy to talk about 721s. It's a technique that we use all the time, and we're one of the few companies that use it outside the REIT world. But it's a nice way to go depending upon your family or your company's, you know, tax goals. Okay, anyone else? All right. Well, you know what? Our goal is to keep this, 20 to 30 minutes. We're at 30 minutes. So why don't we break? I know everyone registered with Rashab, and I know Mark Gleason has all the information. So we'll share contact information. Just know that I'm available for calls. Mark's available for calls, and hey, we hope we can help you out if you're trying to solve this. And whether you solve it with one of our company assets or someone else, we're just happy to be involved. So thanks everyone for your time and joining us on this call, and have a great Thursday, everybody. Thank you.
Thank you, Duane.
Thanks a lot, Duane. It was very informative.
Great. Thanks, Mark, for sending it up.